Kitco News special coverage of the Pacific Bitcoin Festival is brought to you by Swan Bitcoin.
Welcome back to our coverage of the Pacific Bitcoin Festival in Santa Monica, and we are continuing our conversation with the renowned macro strategist Lyn Alden and the author of the recently published book, Broken Money. So, Lyn, we were chatting in part one of this interview and discussing how we're seeing a lot of volatility on the political side of things from elected leaders. And what we're also watching significantly in the markets is what we can expect from unelected leaders, being the 12 members of the Fed that have so much sway and so much power, not only over the US economy, but obviously over the global economy. And that's a point that you addressed in your book, that here we have a group of 12 men that have such significant influence over such a huge part of our lives. Expand on that for us.
So interest rates and balance sheet size affect the price of money. And if you look in most markets, if we ask, are price controls good? Most of us would say no. Price controls are not historically effective. They're not theoretically effective. Markets should set prices. But in this kind of current era, we have price controls for the price of money, or specifically the price of credit. And so rather than letting the market kind of determine what is an appropriate price of credit, it's highly influenced by the central bank. So they set short-term interest rates. Sometimes they even override long-term interest rates, like what Japan's doing now or what the US did back in World War II. But basically various parts of the interest rate kind of pricing mechanism are heavily set by the centralized group. And it's literally 12 people that decide. It's 7 members of the board of governors, and then it's a revolving set of other central bank heads. And some of these are appointed. None of them are elected. Mm-hmm. And so it's almost like a council of elders deciding this is the price of money today. And then, they divine the tea leaves, and every 6 weeks, everybody tunes in to see what color smoke's going to come out of the group of 12 people sitting around the table decide. And that's one of those things that I think it's, when people look back in the future and see that this is how we manage money, this is how we manage literally the most important ledger in the world, which is the Federal Reserve. It's not only the base layer that we all use here in the United States, it's the ledger that almost every country ties into. Right. They own US reserves as assets, and then also they have on average, especially developing countries, they have a lot of dollar-denominated debt. So both their liabilities and their assets to various degrees are tied into this ledger. Domestically, we're tied into this ledger. So basically, hundreds of millions of people domestically, billions of people globally, and there are 12 people that can decide, should interest rates be 2%, 3%, 5%, 7%? Yeah. Should we expand the base layer of money? Should we do QE? Or should we decrease the base layer of money? And so it's kind of remarkable that that's the system we have today.
It really is, especially when you put it in that context, that we have these unelected people that have so much sway over our lives to the details of, can I afford to buy a home? Can I have shelter for me and my family based on what these guys decide and how they handle the process, that are able to potentially, as we've seen them do, devalue years and years of hard work and savings by their decisions. And it's just kind of unfathomable that we don't even elect them. I mean, we feel that we have some kind of potential power over the political system in a democracy, but when you highlight it like this, it just shows how completely disenfranchised we are. That probably the most important aspect of our society in terms of functioning is money. And here we have people that we have no say in how they operate, making such big decisions.
Yeah, I would describe the central bank as the fourth branch of government here in the United States. And kind of the Supreme Court, like we don't elect the Supreme Court, but they are appointed. The Federal Reserve, at least a majority of the members are appointed, but it's still in a very opaque process. The whole structure is something that people don't really understand for the most part. Yeah. And it's just so impactful. And for I think most other markets, we wouldn't really put up with price setting on a long-term basis, but that's what we have to do in money. And so, it's funny because they often, and this is one of the big criticisms of them from certain schools of economics, is that they're often putting out fires that they themselves started. So right. They lower interest rates, they make liquidity available. People then go out and they build credit, they build debt, and then things get overheated. So they start tightening the monetary condition that breaks the debt that they previously enticed to happen.
Yeah.
And so they both devalue savers, but then they also sometimes go after debtors that they themselves encourage to get in debt. And right now, I mean, one of the big narratives is that one of their metrics for trying to get inflation down is they're trying to get unemployment a little higher.
Right.
So there's literally a part of the government, essentially, that is doing their best to slow down wage increases and create more slack in the labor market.
Right. Basically rooting for people to lose their jobs.
Exactly.
Yeah.
But of course, that's a few years ago, they were rooting for the opposite, but they were debasing the money to do so. So there's multiple different stakeholders here. And at any given time, they might be in one of their camps or another camp. And we have to hope that these 12 people get it right. And I would say their track record is not strong.
No, to put it mildly. Yeah. And of course, it all links back to the idea of the fiat monetary system, which something like Bitcoin aims to fix. And you make that point in your book, Broken Money. Before we get into how Bitcoin does that, the reality is that we're all functioning in this fiat world, and we do sit here and pay attention to every little word that Fed Chair Jerome Powell says. Did he use this verb? Did he use this adjective? We parse through the Fed meetings looking for what language changed from the last one. Where are we in terms of what you do expect these unelected leaders to do next? Jerome Powell has been signaling higher for longer. There's been an expectation of perhaps one more interest rate hike. Then we've got the likes of Jamie Dimon saying he wouldn't be surprised if we get rates at 7%. We should be mentally prepared for that. He said that during a Bloomberg interview on October 2nd. And also when he was speaking to the Times of India on September 26th, warning that the world may not be prepared for 7%, just like we didn't really think 5% was even going to happen. And that we need to start factoring that in. Similar sentiment from Neil Kashkari, another one of the unelected elders blowing smoke signals, saying that there is a fair chance that the central bank will need to raise interest rates meaningfully higher. There we are interpreting their words in order to bring down inflation. So what do you see happening in terms of the next couple of rate hikes or pauses?
So I think the next couple of rate hikes are more in this pause type of time frame, because they've gotten to the extent where, at least the way they measure it, they have positive real yields, even though the inflation metrics are not down to 2% target yet. And they know, and they've said before, and it's true, that this comes with a lag. Their effects come with a lag. And one way, a key mechanism for why that is that just because they raise interest rates doesn't mean that everybody's debt changes overnight.
Sure.
It doesn't really change until things have to be refinanced, things mature, things get refinanced. And so there's still a lot of weaker companies out there. So there's commercial real estate, there's junk rated companies with shorter duration debt. There's small businesses that are relying on bank loans. These are pretty short duration types of liabilities. And all of that has to be refinanced in the next coming years at these higher rates. And so some of the downward pressure we've seen from the prior tightening has not necessarily impacted markets yet. And I think that now they're getting to a point where they're going to be more in that steady range. Maybe we'll get maybe we'll get another 25 basis points. We'll see if they're either on the every other meeting schedule, or they might even start slowing down more than that to kind of see what they've already done. And I think a more interesting question to watch is what's going to happen with their balance sheet, because if we do continue to see trouble in the long end of the curve, even though they don't directly set the price of the long end of the curve, unless they choose to do yield curve control, they do influence it by buying or selling long duration bonds. And right now, with quantitative tightening, they're effectively selling long duration bonds. They're letting them mature off their balance sheet. They're not reinvesting them. And if you do start to see liquidity problems in the treasury market, similar to 2019, when they had to stop their balance sheet reduction, you could see that again. Now, they do still have the very large reverse repo liquidity facility, but that's only good for funding T-bills. And so I don't think we're quite at that 2019 period yet where they're going to run out of room to keep reducing their balance sheet. But I do think we're in kind of the second half of this phase where maybe next year is when they get to a point where they're no longer able to keep drawing down their balance sheet. And then they either have to hold it steady for a while or start gradually increasing it again.
Okay, so what does that mean in terms of your outlook from a broader economic point of view? Recession, stagflation, where are you on that?
I'm in the kind of the recession.
Soft landing?
I'm more in the recession / stagflation camp. I think we're going to have some areas of still sticky inflation. I don't think economic indicators are going to be very strong in the next 6 months or so because, again, a lot of this debt is still, a lot of these higher rates are still trickling through the private sector. But I think one way to look at this is kind of like industry by industry. So if you're in an industry that's not very rate sensitive, right? So for example, investment grade corporations, they locked in a lot of long duration, low yield debt. And so they're not really impacted too heavily by these interest rates directly. Same thing for homeowners that locked in 30-year fixed rate mortgages. So there's certain areas of the market that are more resilient here in the US. There's also, if you're on the right side of these $1.6 trillion plus deficits, if you're getting, if you're a company that is making money mostly from, say, upper middle class senior citizens, for example, you're probably doing pretty well in this environment. And so I'm not really too concerned about some travel companies or some of these other types of entities. I think that we have to be very kind of industry specific. And when we look at the post-dot-com bubble recession, so like the 2001 type of recession, generally that was actually a pretty mild recession by most metrics. So GDP didn't go down very much. Unemployment only spiked a little bit compared to recessions around it, but you still had a lot of turbulence in financial markets. And so I generally I don't really see a gigantic unemployment spike ahead of us. I don't really see kind of this widespread disinflation, deflation, kind of major recession type of environment. But I do think we're going to be more of an economic malaise, a stagflationary malaise. And then certain industries I expect to have hard landings. I think we're already seeing signs of that. Things like commercial real estate, things like certain small businesses. That's where I think you get more of a hard landing. And other parts, I think, muddle through until we get to that, 2024, 2025, next liquidity cycle. And then that's when you probably want to be long a lot of things, including things like Bitcoin.
Right. Always back to Bitcoin. Like the consistency there. If we do have this government shutdown, one of the things that will likely happen is that the Fed won't get the data that it uses to make its decisions, which would probably lend itself to just then go with pause until it gets resolved. But let's bring it back to what we were discussing in the first part of this interview, and the idea of you have these pivotal moments in history that only upon reflection do you realize how significant they are. And you mentioned what happened when the US kicked Russia off the SWIFT system in response to its invasion of Ukraine and the weaponization of the dollar. Now, last time we chatted, we talked about de-dollarization as a growing theme and a potential bifurcation of the global monetary system. And that was ahead of the BRICS summit that was happening in August in South Africa. There was expectations by some that at this summit there would be some kind of progress towards a common BRICS currency, potentially backed by a basket of commodities, but that there would be some movement in that direction. That didn't happen. What did happen was we got an extra 6 members invited to join the BRICS plus 6, Saudi Arabia, United Arab Emirates, Argentina, Egypt, Iran, and Ethiopia. What do you make of the expanded BRICS? Is it more powerful because it's a bigger alliance representing more of global GDP? Or is it less powerful because it's more voices with more infighting, making it harder to come to any kind of cohesive agreement?
So I've generally been in the moderate camp about this whole kind of BRICS movement. I do think we're seeing a more multipolar world. I think we're seeing groups unifying that are, in opposition to entities like NATO and, the G7. I think we are seeing these kind of other major blocs emerge, and I think it's going to be a long-term trend. Adding more major oil producers, I think certainly increases the overall power of BRICS. Egypt also controls the Suez Canal, and they have one of the larger militaries in the region. And so that does bolster their overall geopolitical significance. I think calls of a shared currency are overdone. Similar to the euro, a problem you see with multiple countries trying to have a shared currency, especially if it's, it's kind of a centralized currency, is that they all have very different economies, and they all have very different capital markets. And so when countries hold foreign exchange reserves, they don't generally hold the currency itself. They hold a bond or something like that denominated in that currency, even equities in recent years. And the depth of the capital markets of these BRICS nations is not very big compared to the US or parts of Europe like Germany. And so that's the problem of making an attractive, currency or kind of currency block that people want to actually use. I think instead what we're going to see more and more of is bilateral currency agreements or multilateral currency agreements where they decide, this country's going to sell to China oil in Chinese currency.
Yeah.
And that's different than this broader kind of, shared currency. There's also the fact that when you talk about backing a currency, the problem is if you have a fractional reserve banking system, so you have very limited control on the long-term supply of money. If you back that by something finite, you're just setting yourself up to eventually break your peg in the future. And so I think that although they have made it so that you can buy commodities in these currencies more readily, it's different than actually pegging a currency to a certain material at a certain rate. And it's different than having a shared currency. So I think it's relevant, but I think that headlines generally get overdone on this type of thing. We also see another thing worth pointing out is a lot of these countries are trying to de-dollarize from the top. It's generally a slow process. You're chipping away at a big network effect. Mm-hmm. Imagine if you're an app producer and you decide that you don't want to work with Apple or Google. You don't want to be in their ecosystems.
Good luck to you.
Yeah, and you get together with a bunch of other app producers and we're going to build our own phone or we're going to build our own app ecosystem. Even if it's natural that you want to do this, even if there's a lot of demand for it, you're going against very powerful duopoly in that case, right? So in this environment, a network effect, a duopoly, you're inherently at a massive disadvantage. Even Microsoft back in the day, they had their own app ecosystem for a while when they were more in the smartphone business, and they couldn't chip in. They couldn't crack into that. And so you see a similar thing with currencies today. You're up against a very strong network effect. And for a lot of these countries, if you go to the street markets on these countries and you say, what kind of currency do you want? A lot of them want dollars. And so the network effects of the dollar, I think, are on the wane. So we're past the peak of kind of US dominance, dollar dominance. But this is a long network effect that still takes a long time for other countries to organize themselves around, find alternatives, figure out who to trust, build external reliable settlement systems, and then actually get enough liquidity on them that they are relevant.
Right. And trust, of course, is a big issue. And we know that India and China have been at odds on a number of fronts. So that is potentially going to cause some kind of conflict there. How do you see this bigger group that wielding its influence? You mentioned that Egypt has control over the Suez Canal, which is an excellent point. And we've got Saudi Arabia and United Arab Emirates, and Iran, big oil producers. How do you see them, if you see them, collectively wielding influence? Is it mostly through this idea that you said of trading in other currencies, not the dollar?
Yeah, I think that's the key thing. I think building their own, you want to have basically energy producers, and then you want to have goods producers, service producers, right? So China produces goods, India produces a lot of services, some goods as well. And then you have all these major energy producers. Brazil's a major multi-commodity producer. Russia's a major multi-commodity producer. They have kind of all the ingredients or most of the ingredients you need for a circular economy. I mean, they're a very large percentage of global population, a very large percentage of global GDP, very diverse economies. And so to the extent that they can build physical trade routes, financial trade mechanisms that don't involve the dollar or dollar systems, I think that's the direction to really kind of focus on here as something that they're trying to do. Or things like holding gold as a larger percentage of their reserves because they don't have to trust the US, they don't have to trust China, they don't have to trust anyone if they self-custody their own gold.
Yeah, and people were expecting the price of gold to move up on the increased central bank demand. We haven't seen that. Why is that?
So I think, if you purely looked at gold compared to real interest rates, gold actually held up pretty well compared to where you'd expect it to be, just looking at the real interest rate correlation that it historically is pretty strongly correlated with. So I would say that gold is better than it could have been given the aggressive Fed tightening we've seen, although it has been lackluster relative to the equity market, relative to some other assets that you could have owned. And so it's kind of been in the middle. It's been a little bit disappointing, I think, in terms of its overall price appreciation, but it's held up better than it could have given just the sheer amount of tightening that happened. And so we have, on one hand, foreign central banks are around the margins continuing to increase their gold reserves. You don't really see a lot of domestic interest in it. So you don't see a lot of hedge funds going into a lot of this fast money. And 3,000 tons of gold come to market every year, and that supply needs buyers. And so until you get that big influx in demand, I think gold is somewhat range bound. But I do expect it to eventually break out of this range that it's been in. The main thing, I think, is when the Fed gets to the end of its tightening cycle, And when it gets to the end of its balance sheet reduction cycle, and it's no longer to kind of maintain that tightness, either because inflation's eased, recession's kind of here, and then they start easing again, or because inflation's still hot, but they just can't keep tightening anymore. They can't keep reducing their balance sheet because they get sovereign bond liquidity problems. When you have that kind of end to that tightness for one reason or another, that's when I think gold and other assets are likely to do pretty well, because when you have that rising yield, rising dollar environment, that's put a lot of downward pressure on all these kind of anti-dollar trades for the time being.
Right. And you mentioned that people on the ground still want dollars. And I know you've discussed this. You mentioned it in your book. You've discussed this on various platforms, how if you're in Lebanon, for example, you want to keep your dollars and you want to keep them in a box under your bed because you don't even want to have them in the bank, considering what we saw with the banks cutting off access to people that did deposit money and or dollars. You mentioned that it's a similar phenomenon in Egypt. So people that want access to dollars are now able to potentially do so in an easier way through stablecoins, right? Part of the argument for Bitcoin is that it would help these people that suffer from major currency devaluations in other parts of the world. If there is greater access to US stablecoins, does that impact the adoption of Bitcoin for those people that are looking for store of value assets?
So I think in the intermediate term, it does. These are competing monies that people in these countries can choose from. One is generally doing better in terms of price appreciation, better scarcity metrics, more decentralization, but more volatility. That'd be Bitcoin. Stablecoins appeal to people that, a lot of these people in countries, they want dollars, but it's hard to get them.
Right.
Their bank won't sell them to them. You can only bring so much physical cash through an airport legally. And so there's only so much dollars in these countries that people can get their hands on. And stablecoins represent a new vector in there. So if we kind of look at the currency map around the world, there's 160 different fiat currencies roughly. The top handful hold on to their value pretty well. Then there's this long tail of rapidly devaluing currencies. Currencies with money supplies that are going up 15, 20, 25% per year or more in many cases. And so they seek out external monies. They say, okay, I want to hold gold, I want to hold dollars, I want to hold Bitcoin, whatever the case may be. And for some of these more tech-savvy ones, Nigeria, for example, people in Argentina have been through this enough that they've established a lot of ways to get dollars. Stablecoins are a way that they can hold dollars without trusting their local banks, and instead they're trusting basically an offshore bank. They're trusting an external bank. It's kind of like offshore accounts for the middle class rather than just the wealthy class. And so that is an innovation, and it is serving a practical need that is out there. And I think that probably persists for quite a while, as long as either US regulators don't go after stablecoins aggressively. They could. So Argentina can't really stop people from getting into stablecoins effectively, but the US government, if they wanted to, could stop people from getting into stablecoins. And then two, if we get to a point where even the dollar itself comes under considerable weakness in, say, the Fed's no longer able to tighten, there's an ongoing fiscal crisis, that's when you could get significant dollar weakness and Bitcoin kind of breaks out from that. So I think in the intermediate term, stablecoins are a powerful monetary technology along with Bitcoin, but people do have to understand the risks, that these are centralized offshore assets.
Right, but providing an interim solution for those people that are seeing their local currencies completely debased, even though the bigger picture is to get them off fiat and into Bitcoin, into a sound money standard. We were chatting about how the BRICS are probably not going to go to a commodity-backed currency because then it limits your ability to have control over the currency. What does that mean in terms of the prospects then of a return to the gold standard or a potential adoption of a Bitcoin standard? Because the big picture is at conferences like this is that sometime in the future there will be a Bitcoin standard. Do you see that as a possibility, as a likely possibility, or as a pipe dream?
I think it's a long-term thing to monitor. I do think that the way that markets work in terms of money, especially on the global scale, is that over time people want to get out of weaker monies as they can, and if there's all this kind of fencing that kind of keeps them in, but technology is a way to kind of break through that. And so it's when we see kind of these countries fail, like these currencies fail, they generally don't return to the gold standard. They if anything, they dollarize. That's usually their go-to. And so we generally see that as developing countries have currency problems, the developing currencies kind of get inroads in there. And the big question is what happens when eventually these major developed currencies fail or begin to have their kind of ongoing inflationary spiral in a similar way you see in emerging markets. So basically when their debt levels get so high, when their interest expense is completely untenable, when we have a energy shortage, for example, and you see kind of just money printing from these central banks, what happens then? What is the apex predator asset that comes after them? In a similar way that the dollar comes after Argentina, comes after Lebanon, what comes after these major currencies when they eventually start to have problems? And really the only two options I think are gold or Bitcoin. In a world where Bitcoin was never invented, gold would be the only possible fallback mechanism to recapitalize the system, reset, and unfortunately probably build the whole system again. You probably would fractional reserve gold again and kind of repeat this cycle over another century. I don't know. Bitcoin presents another path we can take, and the question becomes, will Bitcoin remain secure and decentralized enough to kind of hold that burden? It's scarcer than gold in the sense that as lower terminal supply, so eventually zero inflation, compared to gold's on average 1.5% inflation per year. Bitcoin is also portable, so you can bring it around the world with you. You can memorize 12 words, and you can bring all of your Bitcoin with you. Whereas if you try to bring dollars or gold through an airport, you're going to be pretty restricted in how much you can legally bring through and practically bring through. And so that portability and that extra scarceness gives it a really powerful advantage. But of course, it is reliant on the global telecommunication system. It is reliant on being able to survive against potential attacks or bugs. And so it's, we're still less than 15 years into Bitcoin's existence. And I think every kind of cycle it goes through is another test to see how resilient it is. And to the extent that if Bitcoin does not break, if Bitcoin cannot be captured or defeated in some way, I would expect it to continue capturing market share. And then should whatever reason it fail, gold is still a fallback option. It's something that, the power goes out and you have gold, you still have your own bearer asset money. So I still think gold has a role even in a Bitcoin future. And the main question between gold or Bitcoin comes down to, can someone figure out, can nation states break Bitcoin? Can someone try to find a way to break Bitcoin? Will Bitcoin ever fall from its own incentive structure? Like will it ever kind of centralize in a way that damages it? And if not, I think it continues taking market share.
Wow, so a lot to unpack on that one, Lyn. I was going to wrap up, but now you're taking me to a whole other direction in terms of centralizing Bitcoin. And you mentioned the BlackRock spot ETF, and that is raising concern that in a way centralizes custody of Bitcoin. When you have the largest asset manager in the world and potentially others like Vanguard getting a spot Bitcoin ETF and they're centralizing the custody, that hurts the mission. On top of the fact that you have BlackRock moving into the Bitcoin ecosystem, they've been buying up some of the miners. Does that potentially pose a problem in terms of the original vision of Bitcoin when you have these giant institutions taking over custody and also taking over part of the infrastructure?
I think as long as they're unable to get above a certain percentage, I don't think it's an issue at all. And I think it's inevitable. I think basically if in a world where Bitcoin is successful, large institutions are going to own chunks of it. That's eventually even central banks would own significant.
We have a Bitcoin standard.
Exactly, and so over time, I think it's one of those things. If any one entity were to own, say, 20% of Bitcoin, I'd find that very concerning because if there were kind of attempts at forks and things like that, they'd have a lot of pricing power to help determine which fork can win. But if an entity has a few percentage of the Bitcoin network, I don't view that as an attack on Bitcoin. And in general, an asset that is, the scarcer an asset is and the faster it can be withdrawn, the harder it is to build large paper markets over it, right? So one of the challenges with gold is that as scarce and attractive as it is, the portability is limiting, the divisibility, the verification is limiting. And so historically what happens is people want to hold their gold in vaults and then it gets fraction reserved and rehypothecated. And that eventually breaks after decades. Eventually entities like China or India just kind of keep taking the gold and eventually things break. Yeah. But that's like usually a multi-decade process. Whereas if you have something like Bitcoin that can be withdrawn quicker, every 10 minutes on average, the entire network is audited by the node network. You can bring Bitcoin out. it grows more slowly, it has zero terminal inflation, that shrugs off attempts at rehypothecation and fractional reserve more quickly. The cycle's years instead of decades. And so again, it comes down to, can someone find a way to break it? Does the mining incentive structure ever fail? I mean, so far after 15 years of operation, the largest miners in the world are still like, say, 5% of the network or less. And they're not the same ones that had 5% of the network 5 years ago. And so the mining distribution is still very decentralized. Mining pools are a little bit of a concern, but they don't custody the miners. So if a mining pool ever, kind of attempts to centralize the network, miners can just redirect their hash rate to another mining pool. So that's like a mining pool centralization is kind of a risk of a temporary attack, but not a long-term capture scenario. Really, it's about that miner decentralization that matters. I think we have to watch how much hash rate comes to North America, right? So a big narrative in the early kind of Bitcoin period was, look how much hash rate China has. Now America is the biggest miner. And I generally want to see a little bit more global diffusion of the hash rate. I think that's healthy for the network. I'd like to see more in El Salvador, more in Australia, more in Africa, more spread across the world. But overall, I think the current state of decentralization is very healthy. There's still some improvements that could be made with, a little bit more decentralization, but I think it's holding up very well.
Okay, and you do obviously discuss Bitcoin at length in your book, and as the problem solver to the broken monetary system. And you explain essentially how money is really just a ledger. And it sounds simple when you say it, but the way you broke it down, it's kind of like very sort of aha moment when you kind of think it really is just a way of keeping track of, you did this for me, so now I need to do this for you, and I can take the energy that I did for you and give it to somebody else. And it's just a way of dispersing energy and keeping track of what's happening through an open ledger. And Bitcoin, of course, is the ultimate open source ledger. And it's a point you highlighted in your book. So walk us through that a little bit. I'm not doing it justice remotely.
So when you think of money and what it is, basically money solves the problem of the double coincidence of wants. If we want to trade something, I would have to have something that you need, that you have a deficit in and I have a surplus of, and you would have to have something that I need, that I have a deficit in and you have a surplus of. And we might have trouble finding that arrangement. And there's really two ways to increase the rate that we'd be able to trade. One is that we can defer that through time, so credit. So for example, if you need something and I have a surplus of something, I can just give it to you because I know I'll see you at the next conference. Maybe you can pay me back then, right? So we can defer a trade by resting on trust and time. That's credit. The other way is that we can have a highly saleable good that we always want more of. We never have too much of. Money, for example, gold, shells, dollars in the current environment. That's money, something that no matter how much you have, it's this divisible, portable, liquid, scarce thing. They're always willing to take more of because you always know you can do more of it. It's the most sellable good. And so either by making the unit of account more unified or by deferring that those are the two ways to solve it. And so we get kind of two conceptions of what money is. One is that money is credit. So it's a human controlled ledger, either a small ledger just between us, or if we're in a nation state or a larger community, it's a ledger controlled by the government or controlled by the central bank or a bunch of local banks. And we kind of use this ledger and we have to hope that they manage it reasonably well. The other option is to kind of use nature as the ledger. So using shells or gold coins and things like that, we're letting natural scarcity of certain commodities kind of administer the ledger for us. So, is nature going to dilute us with gold? Probably not. And so we're kind of trusting in the properties of nature to administer that ledger, and then we update the ledger when we do physical possession. So those are historically the two main types of money, different types of ledgers that we trust. And Bitcoin is a new version which kind of combines elements of both. It's a literal ledger in the sense that it's literally basically a decentralized spreadsheet that is distributed around the nodes, but then it is backed up by electricity, processing power, a tether to real world resources, true scarcity. And so
Proof of work, yeah.
Proof of work.
Just like mining gold is proof of work. Yeah.
And so in the modern day, when we're trusting, what do we want to hold as money? It comes down to what ledger do we want to trust? And maybe we want to trust multiple of them in different ratios. So for example, I might say, well, I don't really trust the Federal Reserve in the long run, but I trust that next week, the dollar is still going to be here, right? So I'll hold dollars for weeks, months, maybe a couple of years. That's one ledger that I'm willing to work with. I kind of have to work with here as an American. That's a ledger that I'm using. Another ledger might be gold. I might say, well, I want the properties of nature. I want this bare asset that I can hold. I'm going to assume that no one's going to mine asteroids or find a crazy deep water deposit and figure out how to get the gold, in my lifetime. And so that's a ledger I'm going to trust. And then we look at the Bitcoin. I think, what problem is this ledger solving? And for the most part, what it's solving is it's even scarcer, it's even faster. It's basically scarcer than gold, faster than fiat. It's globally portable. I can memorize 12 words and bring it everywhere. I mean, for example, I live part of the time in the US. I live a little bit of the time in Egypt, for example. When I'm in Egypt, I don't have access to any gold that I have in the US. If I'm in the US, I don't have access to any gold in Egypt. But if I have Bitcoin memorized with 12 words or written down somewhere, technically I have Bitcoin anywhere in the world. But that, of course, is reliant on a decentralized network of nodes and ledgers and miners. And that equilibrium has to be maintained, that has to be secure. And so that's another ledger. It's a newer ledger, a powerful one that I'm continuing to monitor and test to see if that continues to be very suitable. And so far it is. Yeah,
so far. And that brings up the question of, are we as far along as Satoshi Nakamoto thought we would be at this point? He is credited in saying in February of 2010 in the Bitcoin Talk Forum, where he was discussing Bitcoin and trying to promote the adoption of it, I'm sure that in 20 years, there will either be very large transaction volume or no volume. So that was 2010. We're in 2023, 13 years in. Do you think we are where we need to be in terms of the volume that he's referencing here? He, she, they are referencing here.
Yeah, so what he's kind of pointing out there is that Bitcoin is kind of a binary outcome. Either it works tremendously well, or it probably doesn't work very much at all. It eventually stagnates and dies. And so basically he's saying 20 years from now, does something kill it? Does nobody want to use it? Do people find something better? If so, then you're not going to have almost any volume, perhaps no volume. On the other hand, if Bitcoin continues to be successful, the volumes could be tremendous and the Bitcoin will be prospering in that regard. So at the 14-year mark into that, 14 years since Bitcoin's inception, 13 years since he said that, the Bitcoin network does process trillions of dollars worth of Bitcoin transaction volume. Now, a lot of that is moving between exchanges. A lot of that is people choosing to pull that into their own cold storage. Basically, you still have a lot of overall volume. It's not really yet for medium exchange purposes, but I think that's normal in this kind of early period of adoption where the price keeps going up, where there's capital gains taxes on any sale you might have. People have a natural tendency to hoard it and use it as that savings. But I think the fact that, if you were to go back to 2010 and say, this network's worth $500 billion. The current temporary Speaker of the House hosts the Bitcoin white paper on his website. He's actually a Bitcoin fan. We've had multiple presidential candidates talk about Bitcoin. Yeah. We have a nation that has adopted it as its second legal tender along with the dollar. Right. And they have their own Bitcoin office. You have, the Kingdom of Bhutan was mining Bitcoin. We have some of the Middle Eastern countries getting into Bitcoin mining. We have trillions of dollars in transaction volume. Now, so I do think that we're actually quite far along in that whole vision. And when I picture 7 years from now, so Satoshi's 20-year mark, I do expect we'll be further along. But when you kind of compare where the Bitcoin network is now, where it can go, or what the competition is, when we look at FedWire, so the Federal Reserve's base settlement system, that settles, and this is not a typo, $1 quadrillion of settlement volumes per year. It was 1.06 quadrillion. That's 1,000 trillions in gross settlement volume. So these numbers can reach extraordinarily high levels. Basically what Bitcoin is a decentralized open source FedWire for the world. And so right now it's still tiny compared to the biggest ledger, which is the dollar system, the FedWire system, the Euro-dollar system built around that system. That's by far the biggest network. Bitcoin is nowhere near getting to that. And I think even in 7 years, it'll still be probably not in the same ballpark as the dollar system. But I do think in 7 years, so Satoshi's 20-year mark, I do think Bitcoin could be another 10x here in terms of market capitalization, transaction volumes, overall adoption. I don't think another order of magnitude would be off the table in that time frame, and I think that'd be considered very successful for that time frame.
All right. Well, we'll definitely check in with you in 7 years' time. I'm sure a lot sooner, because as we just said, between the times that we catch up at Bitcoin conferences, there are always significant developments and advancements. Fantastic chatting with you always. Lyn, really appreciate it. And again, highly recommend the book. Lyn, thank you so much for joining us again on Kitco.
Thank you for having me.
All right. And thank you for watching. Remember, if you're watching us on YouTube, make sure to subscribe. And if you enjoyed this video, hit the like button. From me, Michelle Makori, and the Kitco team, we'll see you soon.
Kitco News special coverage of the Pacific Bitcoin Festival is brought to you by Swan Bitcoin.